Traditional debt crisis and crashing currencies points to a brewing economic downturn in many developing nations. Africa has been no different. It is witnessing an economic slowdown, and the prevalence of COVID pandemic has hindered the flow of necessary finances for ongoing infrastructure development projects. Fearing default on payments, a number of African nations are renegotiating loan terms with Chinese entities, including the Department of Interest payments, and suspending the non-viable projects. In this slide, we look at the latest rise in loans from the International Monetary Fund, the risks at hand, and hope that the continent will emerge from the debt crisis it is currently in.
Africa has a cluster of countries going to the IMF, but Tunisia looks like one of the most at risk. Tunisia, which is facing a financial crisis, is seeking to reach a loan deal in return for an unpopular reform package to shore up its struggling public finances. A near 10% budget deficit, one of the highest public sector wage bills in the world, and there are concerns that securing or at least sticking to an IMF program may be tough due to President Kais Saied's push to strengthen his grip on power and the country's powerful, incalcitrant labor union. In early 2022, the IMF, through its managing director Kristalina Georgieva, published a report that said in both 2021 and 2022, Africa's projected growth trailed the global average. It is in this context that the IMF took unprecedented action to support member countries in a project it called Stepping Up With and For Africa. And soon after the statement, a trove of countries were in the list to be loaned. This included the Democratic Republic of Congo, which received $455 million IMF loan for pandemic fallout. Madagascar, which received $67.5 million disbursement under the country's 40-month extended credit facility program, which amounted to about $135 million so far. Niger, which got a disbursement of about $53 million. A $638 million extended fund facility and extended credit facility was approved for Benin. In March, the IMF Executive Board completed the first review of the ECF arrangement with Uganda, allowing an immediate disbursement of around $128 million to cover budget needs. IMF Board also approved a $151.7 million to be disbursed immediately to Tanzania. IMF said that the 40-month financing package would assist Tanzania's economic recovery, address the spillovers from Russia-Ukraine conflict, help preserve macroeconomic stability, and support structural reforms towards sustainable and inclusive growth. Furious borrowing has seen Ghana's debt-to-GDP ratio soar to almost 85%. Its currency, the cedi, has lost nearly a quarter of its value this year, and it was already spending over half of tax revenues on debt interest payments. Inflation is also getting close to 30%. Egypt has a near 95% debt-to-GDP ratio and has seen one of the biggest exoduses of international cash this year, some $11 billion. Fund firm FIM Partners estimates Egypt has $100 billion of hard currency debt to pay over the next 5 years, including a meaty $3.3 billion bond in 2024. Addis Ababa plans to be one of the first countries to get debt relief under the G20 Common Framework Program. Progress has been held up by the country's ongoing civil war, though in the meantime it continues to service its sole $1 billion international bond. And finally, Kenya spends roughly 30% of revenues on interest payments. Its bonds have lost almost half of their value, and it currently has no access to capital markets. A problem with a $2 billion bond coming due in 2024. Economists say these countries are the most vulnerable just because of the amount of debt coming due relative to reserves, and the fiscal challenges in terms of stabilizing debt burdens.